I should get some sleep.
Welcome everybody to the Daily Recap Show where we talk about stocks and the financial markets. My name is Chase. If you like this video, please subscribe, hit that notification bell as well as the like button and leave a comment for the algorithm. Let's get into it. This is the daily heat map of the S&P 500 and US stocks had a very mixed day as investors weighed fresh consumer inflation data that looked to keep the Federal Reserve on pace for another rate cut in the next month. Stocks that are rate sensitive outperformed today, and stocks that rallied on the market euphoria in the last couple of months actually digested some of those gains. A lot of that had to do with technology, communication services, healthcare, and some of the names here in financials. Other than that, we saw a pretty bullish day with Amazon, Apple, and Microsoft keeping the index afloat, as well as other cyclical sectors, especially on this side of the heat map. The Dow Jones gained 0.11% today. The S&P 500 was flat. The Nasdaq actually fell 0.26%, again on the back of Google, Meta, as well as semiconductors. But there were huge movers today. Save Airlines plunged as much as 70%, closed the day down 60% today, and that was on the back of bankruptcy news. They're talking with creditors to restructure their debt after their merger talks with Frontier collapsed. Pretty much this business is now scrambling to get liquidity to save it from bankruptcy, and when you hear that, markets are just gonna pull out immediately. Investors don't want anything to do with this, and that's why the stock fell 60% here today. Another market mover to the upside was Kava. Now you only see it closed up 1.59% on the day. It saw trading as high as 171, which is a move of 17% after its earnings, and pretty much they beat on the top line and bottom line. Sales store growth increased 18% year over year. And the company lifted its full-year same-store sales forecast as it expects to open much more stores than previously guided. Kava said it now expects same-store sales growth by 12% to 13%, up from the previous 8.5% to 9.5%. So great earnings, right? But we did see a pullback. So for those of you that actually missed this earnings, this is actually an opportunity for you guys to get back. That is, if you believe the stock can do what it did. Nonetheless, I thought it was great earnings and an opportunity is presenting itself here for those of you that missed out. But let's go back to the broader market, and the best performing sector here today was XLY. This was on the back of Amazon. Amazon really rallied today, lifting the discretionary space, but we also saw outperformance in XLE, XLRE, staples, materials, industrials, and financials, even though financials was pretty much flat. The SPY was pretty much flat today, same with the XLC. The worst performing sectors continue to be technology, XLK, especially this week, as well as some of these defensive sectors, healthcare and utilities. And while it was a fairly bullish day in sectors across the large size, the S&P 500 was flat because technology was the worst performing sector, and that same sentiment actually reverberated throughout the broader market. We saw mixed price action in mid caps and just declines across the board here in small caps, with small cap growth being the worst performing sector, but really it was declines across the board. We did see some outperformance mid cap value, large cap value, as well as large cap growth. I guess a lot of this has to do with names like Amazon and not so much the semi names, but all in all, very mixed price action in the market today, as well as globally. I wouldn't even say mixed, I would say mostly declines globally. We saw Asia was in the red, same here with Europe. We know what the US did. South America was actually fairly green, same with Canada, but they were red yesterday. And then we had the Australian market very red, along with the US as well as Southeast Asia. So a fairly red day across the board. And again, we see profit taking and market digestion. But what somewhat did help sentiment in the US today was actually CPI data. Now, inflation data dropped on Wednesday for the month of October, and it pretty much came in line. The forecast for month over month was 0.2, in the core figure 0.3. That's exactly what we reported, and then the year-over-year figures were exactly the same. And immediately following Wednesday's market release, markets continued to price in another 25 25 basis point rate cut in December after the central bank cut rates by the same amount last week, traders currently see more than an 80% chance the Fed will cut rates by 25 basis point next month, and that was up from 60% just a couple of days ago. This is what the inflation chart looks like. Now, the consumer price index year over year actually increased ever so slightly to 2.6% over the prior period. This yearly increase actually matched economists' expectations. That's actually what we were expecting. So a move from 2.4 to 2.6% on the year over year figures. The index rose 0.2% on the month over month figure, matching the increase seen in September and also on par with economists' estimates. So pretty much inflation continues to do what the market expects it to do, and that's decelerate. We have seen a slight increase lately, but that actually has to do with some of the comps we're seeing. So the path from here on out is going to be a lot more bumpier than expected, but the market kind of expects that, and we sort of have priced that in already. And then all of this culminated in market breadth continuing to deteriorate ever so slightly. We saw the noisy 5-day moving average fall quite a lot. Take it with a grain of salt. The longer term averages continue to be very robust, but we are starting to see slight deterioration in the 20-day, 50-day, as well as 100-day moving averages and the 150-day. So the euphoric market momentum that we actually saw last week, not exactly carrying over into this week, but we're not exactly falling apart. I think what we're seeing is just a lot of profit taking and digestion. And I think the CPI news we actually got today really will help sentiment leading up into all of the economic data and into the rate cut we get next month. This is exactly what we needed from the CPI print, and this just goes to further add fuel to the strong economic picture we are seeing in the US. But let's hop on the charts. Now, markets were mixed across the equity spectrum, but commodities fell heavily. Crude, silver, gold, all falling as much as 1.2%, particularly in silver. Bitcoin gained 1.45%, and the fall we saw in commodities actually had to do with the rising US dollar. It continues to move higher, and the dollar actually shooting up now to the 106 level. I don't know where the top is. I couldn't actually tell you, but the markets like the stronger domestic policy from a Trump administration, and that means a stronger US dollar. Today, we saw the 30-year and 10-year yield rise, the 2-year yield fall, so shorter end rates falling after that CPI print, but actually rising on the longer end. Very interesting data right there, especially on the back of what was an inline CPI print. And then looking at equities in all, looking at small caps, the IWM was down a percentage point. That was also on the back of a 1.5% decline yesterday. So a bit of brutal price action in the small caps, but we are seeing some fairly positive momentum here in the after hours, up 0.21% in extended hours. The Qs as well up 0.11%, and the S&P 500, the RSP virtually flat. The S&P 500 and NASDAQ 100 was up 0.2%, down 0.16%, and then mid-caps fell half a percentage point as well. So very mixed across the board, but mostly flat to declining markets we saw today. And then looking at the S&P 500, the flat to declining momentum we saw today was actually on the back of pretty much us reaching the top end of the core resistance and coming off, and that's normally what happens. We haven't seen any changes to the gamma chart. The S&P 500, we continue to trade in positive gamma at the top end of the range with slight bearish momentum to the downside. We see the same here in the NASDAQ 100. We also see the same in the RTY, although we've seen a little bit more of a pronounced move towards the gamma flip. And so I would say that if you are looking to get into the IWM, this is a great position, but maybe you have one more day of trading where we close above the positive gamma, because we did see a little bit of bearish momentum below the gamma flip zone, meaning we did see negative gamma price action today. However, although on a technical basis, this is actually where you want to get long after some consolidation for us to move onward and upward, break the highs we made just a couple of days ago and break all-time highs we made 18 months ago in the IWM. I'm very bullish on small caps, and if you look on a one-year basis and a year-to-date chart, this is a very bullish price chart, and we actually see a technical breakout right here, and I do think we are going to go higher. We could bounce from here, but let's see a bit of consolidation around this price area, because if we continue to move to the downside, will be negative gamma, and then we want to aim for the 2300 area. So what we really want to see is just a little bit of consolidation here before we actually make a move to the the upside or downside. However, something to note, look at this wick. Huge amounts of selling did occur today, and that is a little bit of a problem. If we actually hop on the one-day chart for the IWM, you can see after the CPI report, we moved up and then we had a sharp move down where we did see a little bit of consolidation here at the gamma flip. That does tend to happen. As you can see, these levels work wonders. We got a bounce, move up, and we're trading slightly above the positive gamma area now. But all in all, still a fairly ugly day, especially peak to trough when you look at it in the IWM. Nonetheless, guys, we are still in positive gamma across all of these indices, and you do want to buy dips when we do get them. We haven't got that massive dip in the S&P 500 or NASDAQ to the gamma flip just yet, but we'll see if that does come. Looking at the RSP, very constructive as well. All of these indices just look very constructive, pretty much trading at all-time highs. You can't really fault the market. The only thing you can really say is that we're just seeing a little bit of digestion, a little bit of profit taking, especially as the economic data rolls in and we exit earnings season. Now, apart from the major indices, guys, a name I do like as well is PayPal. I mean, PayPal had their earnings. People thought it was the end of PayPal right here, but we've paired those losses and gone ahead and made a new 52-week high. Especially if you actually look at the last week, the last 5 days of trade, PayPal is up a very solid amount, up 6% in the last week. Really great name. I still like it. I still think it's undervalued. Another name I like that I think is fairly valued is actually Paycom. I like all the pay stocks. We actually look on a year-to-date basis. Paycom up about 11%, but we saw a massive fall after their earnings here at the start of the year. My average buy price for the stock is about 150. It's at about this level right here. That's when I bought. I just took one big position. I think I averaged up around this area, but it was just a couple of shares, and we've seen a huge move in earnings ever so slightly. But what we are seeing at the top here is just a little bit of digestion at this top range, looking for the next move higher. Do I think we're going to see that? Probably not. I think we're going to continue to see sideways momentum. After the earnings report, Paycom brought forward a lot of the gains that we would have seen into the run into the next quarter. And then another name I do like, guys, is actually Pexa Group. This is a stock on the ASX. They released their most recent investor update just a couple of days ago, and year to date the stock is up about 23%. We saw some very mixed price action after their latest quarterly update, and they actually reiterated their financial year 2025 guidance, but said they're seeing slower moves in the international expansion, but that just has to do with legislative as well as a weaker economic backdrop there in the Europe region. Nonetheless, I still think this is bullish, and the price action we're seeing is very constructive, relatively speaking, after that investor update. So I do think we are going to go higher here for Pexa Group. The stock currently trades at $13. This is going to be a $30 stock in the next 18 months. I believe that, and probably a $50 stock by 2027, at least according to my discounted cash flows analysis. And that's assuming the UK market expansion goes according to plan. Nonetheless, I like all three of these names. If you're looking at a mega cap, guys, I also like Google. Google is a fantastic company, not quite at all-time highs, but very cheap, the cheapest Max 7, and just executing on all fronts. My fair value for the stock is 199. The stock trades at 178 right now, so I do think there's material upside back to these all-time highs into its next earnings report. So you're looking for individual names, I like those. If you're looking for market indices, I like the RSP, I like the CARF ETF, a fantastic little ETF right here, and I also like the Moat ETF. All of these, I like the individual names. I also just like the S&P 500, the equal weight, the IWM as well, guys. So markets have momentum, and any dips you do get, guys, buy those dips. But I would start to look away from market indices that do look a bit pricey and look at cheaper segments, cheaper individual stocks of the market. Nonetheless, you want to remain bullish because momentum is on the side of the bulls. And looking at seasonality, guys, this is the S&P 500 performance in the last 7 weeks of the year, when the calendar year has returned 10%, and we get each week into the end of the year. And guys, this is very interesting data. You could see the full 7 weeks, 29 wins, 4 losses, 3.5% in just 7 weeks. Absolutely crazy stats. And what we generally see from the first week into the 7th week is very linear returns. Every single week is positive, with the best week actually being the final week of the year, up nearly a full percentage point. And And the worst week actually being the third week from November 26th to December 3rd. We see an average return 0.01%, 17 wins, 16 losses. So a pretty average hit rate right there. But guys, this data right now is telling us that despite a 25.7% return so far for this year, do expect prices to go higher because we tend to see outperformance. And this year has been a spectacular year. In fact, last week we had the single best week of 2024 with the S&P 500 up 4.26%. And the return so far this year in the S&P 500 has been the strongest so far in the 21st century. We'll see if the strength continues into the end of the year. I think we are going to see one of the strongest years so far on record in the last 20 or so years. And a lot of the strength we're seeing is in part due to the fact that fundamentals and technicals are really strong in the market right now. Look at Q3 earnings. This is supposed to be the worst quarter in earnings for the next 6 quarters. And actually, if we look back 3 or 4 quarters, this is supposed to be one of the worst quarters. We are absolutely smashing estimates, and 449 companies have reported so far. So the vast majority, the only big company that's left is Adobe, Costco, and Nvidia. So far, we're seeing 8.6% earnings growth, nearly doubling analysts' expectations from the start of earnings season. We're seeing beats in margins. We're seeing beats in revenue. Very, very strong. This is a solid fundamental backdrop for equities to go higher. 76% of S&P 500 companies are beating earnings estimates. But you can't talk earnings without looking at valuation. And right now, valuations are stretched. Valuations are expensive. At least when you look at the US and the world, including the US, we're looking at PE ratios of 22 times and 19.5 times. This orange dot is where we are currently, and this is the median average. And so you can see we are well above historical averages. I do think there's a reason for it. Companies now are far better than what they ever were in the history of the world. They're far more efficient. They're far more margin accretive, and shareholder value is a top priority for these companies. And that's why we can actually have these huge multiples. But when you look at the rest of the world, things aren't exactly the same relative to the US. Look at something like Japan. The current market valuation is actually in the middle of its median and interquartile range at 14 times. We see very much the similar situation in Asia Pacific, excluding Japan, Europe, as well as emerging markets. So the US, yes, is expensive, and this is making the rest of the world look expensive, all things considered. However, there is a reason for that. And generally speaking, if you look at returns versus valuations, yes, the S&P 500 index is expensive. However, buying at the highs has historically been a good idea, with 18% average annualized returns in the subsequent 6 months versus 13% returns when buying at any other time. And generally speaking, when valuations are stretched, what tends to outperform? Equities and credit tend to outperform. What we really see underperform is actually just gold. And what really outperforms is actually just equities for the most part. So despite valuations looking very, very stretched, the thing is they can go higher. And really you want to ride the momentum trade until the fundamental picture falls apart. And we're not seeing any signs of that happening just yet. And in that case, any dips we get, buy the dip, because the path of least resistance is higher. And diving into the macro, looking at the economy, guys, ever since Trump's victory, what we've seen in US markets is actually a re-rating of growth. We've seen GDP forecasts move to the upside, and we've seen the broad market, the rest of the world, actually trade sideways since Trump's election, and the euro area actually roll over, whereas globally we're just seeing flat revisions. So all in all, the place where you want to be right now is the US. And the truth is, when you look at US fundamentals, the economy, everything is looking really good. Economic growth in the US is running close to slightly above trend. This is the Carson proprietary economic leading indicator, and their economic indicator is telling us that the US economy is not close to recession, and it hasn't been for the past 2 years. This indicator continues to tell us that the US economy is growing on trend or slightly above it, and moreover, the Fed has pointed out that they don't want the employment situation to soften. That's crucial crucial support. So any weakness we do get in the employment market, in the labor market, in the economy, the Fed is going to backstop all of it. And that is why you want to remain long in equities and credit, and to a degree, even commodities, because we are literally in an everything bubble with a supportive Fed, deregulation, tax cuts coming. The business community is booming with a Trump win. And to be honest, this could be only the start of what could be a sensational rally and a strong economy for the next 4 years. And guys, we got the latest Treasury yield forecast here from Goldman Sachs. This is very interesting, guys, because this is where we are right now in the 10-year yield, 4.32%. The futures market is pointing to us pretty much trading flat into the start of 2025, but Goldman Sachs actually see us pulling back all the way to the 3.85% range, which could be supportive for equity. So the huge move in yields we saw, we are actually going to pair those gains according to Goldman Sachs. We'll see if the financial markets are right or if Goldman's analysts are right. If you ask me, I would say the truth is somewhere in the middle. Looking at earnings for the rest of the week, the majority of the week is done, guys. But tomorrow we have Walt Disney before the open, JD.com, Advanced Auto Parts. Those are the big names on Thursday. Then after the close, we have Applied Materials, Oklo, AST Mobile, and that's really it. A ton of power and solar names also reporting on Thursday, and then Friday we have Alibaba. So a big week of earnings, guys. And for data tomorrow, we also get the PPI figures. So that's going to be the big one, as well as Jerome Powell's speech. He has a speech. We're going to see what his thoughts are coming off last week's rate cut, coming off the Trump victory. That's also really key to see. And we still want to see if he believes the move we're seeing in rates is because of a re-rating in growth, a re-rating in inflation expectations, or the market telling the Fed that they're wrong to cut rates right now. So his speech is going to be absolutely crucial tomorrow. And then Friday, we get retail sales. The number we want for PPI is 0.2%. That's the consensus. The forecast is also 0.2%. But if you've made it up until here, thank you so much for watching. If you like this video, please subscribe, hit that notification bell, as well as the like button, and leave a comment for the algorithm. Cheers.